Hello everybody, welcome to the TraderMerlin Show. It is your Wednesday edition, halfway through the week, and we've seen a ton of volatility, lots of excitement, and of course 2 days of sell-off, which has you bulls probably quaking in your boots a little bit. The topic du jour was something that Brandon and I came up with. Actually, Brandon came up with this one. He gave me a couple ideas for show topics for today, and we'll probably do both of them at some point, but I thought it was interesting because we look at what's moving the market, and I made a joke in the Monday Market Must-Know saying, hey, if you really want to know what's going to happen with regards to stimulus or anything really macro moving, just log into Donald Trump's Twitter account because that guy can move a market 3%, snap of the fingers. So today we're going to talk about building a tweet-resistant portfolio. Joining me, I have none other than Mr. Brandon Wendell. Brandon, how you doing?
I'm doing great, Merlin. Thanks for having me again.
Yeah, always a pleasure. You're about you're my monthly review, right? We love having you on about once a month.
It's about all you can take of me.
It is. It's fun because I love Brandon because I get to see all of his Twitter posts. On Instagram, I get all his fish tank posts. So it's nice to see the fish tank there.
Yeah. Oh yeah, it's in the background.
It's glowing in the background. Yeah, the beautiful saltwater tank. What's new in your world, Brandon? How you been?
I've been doing great. Just been busy teaching. I get to teach from home now, which is a lot nicer than having to be on the road all the time. And get to spend time with my wife and my dogs. They're running around here somewhere barking. You'll probably hear them in the background.
Yeah.
But that's about it. Just relaxing, enjoying life.
Sweet. Well, good. Good to hear it. Yeah. And I know you're doing all kinds of things with E-Mini Think Tank. You got a signature series, which we'll talk about that coming up here shortly. But let's get into the meat and potatoes of it. You and I, when we started back on the trading floor days, you started before that, but I started really in the trading floor days in '98. There were things that definitely moved the market. Normally it was an appearance by some CEO or exec on CNBC, but there wasn't any real crazy, bizarre, from left field type of announcements. With social media and what's happened with Twitter and Facebook, especially Twitter, now it seems like this is the way that people want to release data. Not even data, but just opinions about the market. And of course, the biggest mover of them all is going to be President Trump. And he has been able to move portfolios 2, 3, 4% literally in a matter of minutes. And I thought it'd be interesting to talk about building a tweet-resistant portfolio. What can we possibly do to help mitigate the risk that the tweet platform poses to us?
Well, first thing is that you have to realize is the type of risk you're dealing with in the markets. And a lot of people don't even think about that. They get all starry-eyed about how much money they can make if they happen to buy Bitcoin at the right price or jump into the latest, hottest thing. They think they're going to get the next Google or Apple or Amazon. Warren Buffett probably said it best. As an individual in the United States, as an investor, you've got no business buying individual stocks. He said that you basically should look at the indexes and trade those instead, rather than trying to pick an individual security. And that's one of the things you can do to reduce your risk. I myself love trading futures, and I trade indexes on futures because you've got instant diversification with one security. So rather than going out and trying to buy what's going to be the next hottest, greatest stock or try to buy one individual security, for instance, if you buy the S&P 500, you're actually getting 500 different companies in one investment. So while the markets can still move and they can move for or against you, you've got that diversification that's naturally reducing your risk automatically. And, we're talking about the kind of the black swan events, if you will, nowadays. It's not even that much of a black swan. It's almost a normal Thursday.
Right.
But, when you go out and you look, really what it comes down to is you got to follow your technical analysis and understand how to minimize risk in the markets. You can't reduce it completely. That's why you said tweet resistant, not tweet proof, because that's impossible, obviously.
Yeah. It's getting harder and harder, too, because, well, first off, I can't even really say anything because if I say something the way that I want it to come out, everyone's like, oh, well, you've got to be a Democrat and you've got to be against Trump. It has nothing to do with that, guys. It's just simply the way that politicians are using the platform to disseminate information. And again, I would love to know, regardless of political party, all of the people associated with whoever's making these absolute market-moving tweets, because the statement I made on Monday Market Must-Know a couple days ago was talking about how President Tweet said on Thursday, we're not going to do anything with stimulus. No stimulus, not going to happen until after the election. And of course, literally the next day, after the market dropped 1.5%, comes out the next day and he says, well, we have to pass stimulus for the airlines. And then it jumps into other things. Now stimulus is back on. And now I think Trump tweeted out today or yesterday, go big or go home with stimulus. It's like, I don't know what to make of it all, and it's certainly causing huge waves out in the market. So I guess step number one in making a resistant portfolio to a Twitter announcement is stay away from individual securities and go for the well-diversified ETFs. Like you were talking about, the SPY. It's actually 505 companies because 5 of those have dual listing shares, but who's checking on? Not to be nitpicky or anything.
So it's funny. Oh, go ahead. Sorry.
I say when we look at something like that, I mean, is it best to look at something like the S&P 500 because you've obviously got 500 issues. You could do the Wilshire 5000, Russell 2000. I mean, you start to get down to like Dow. Now all of a sudden we're not benefiting from that the extent of diversification or protection.
Well, yes and no. I mean, you got to also look at the volatility when it comes to securities. So a couple things I want to show you. I'm going to go ahead and share a chart here if I can.
Sure.
There it is. Let me share this one. There it is. I think I got it. Looking at my charts now?
I will in about 3, 2. There we go. Got it.
Okay, there we go. Perfect. So I'm looking at the ES right now. That's the S&P 500. Again, you can look at SPY, probably the exact same thing. I haven't viewed this for sure. Yep, there we go. So going back to the 6th as an example, you can see that on the 6th, that was a Twitter drop right there. Okay, so it was affected, obviously, on the SPY. You saw the big drop. And I can also look to see if it happened on the IWM, which is the ETF that follows the Russell 2000. Pretty much the same picture. But the interesting thing was, again, going back to SPY, and I wasn't looking at this per se. I was actually trading the futures, which mimic the index, which also is what the ETF is based on. But going back in time a bit here, even on a 5-minute chart, what you're going to notice is I was looking for a sell opportunity anyway. And the reason why, take a look at where we turned from. Mm-hmm. If we draw out, you can see we have rally, base, and drop right there. So there was a sell zone that I was looking at to exit my longs and look to go short anyway. And I actually had a couple students that came back and said that they had gone short there and made, obviously, you see, when I go back to, I'll do it this way. It's too slow. There we go. So sliding back, you can see that's exactly where we turned southbound, right at that level. So if you do your technical analysis properly, a lot of times you're not going to be caught off guard by these tweets because the market is going to turn and the news actually just becomes kind of an accelerant or an excuse for what was already going to happen. Now, another thing that you can do in order to help figure out what to be looking at for your trading, I do it on futures. So again, let me go back to the ES. And you brought up a kind of an interesting thing, looking at maybe the Dow versus the ES. And I'm going to go out to a daily chart here. And the reason why I'm going to do that is I'm going to add in the average true range.
And as he does that, guys, I'm just going to fill in there. It says, Big Eb says, where's the tweet gain? And you're right. There's multiple things on this chart that you got to pay attention to. Naum says, what did the president say for that drop? He said, no stimulus talk until after the election. And that's why I have this cursor right here. And then I mentioned the very next day. It's like, honestly, I hate to even say this because it sounds like just anti what we would teach on the trading classes is, if Trump tweets out something bad and negative about the market, just buy the dip. Doesn't matter what it's going to happen because in the next day or two, he will spin the complete opposite direction because he's gotten the fear out of the market and then it just rips up. And you notice on this chart that I've got, I'll put my cursor right over where that announcement happened. Here's the red candle of that Thursday where he said, hey, no stimulus. And then all of a sudden, he turned around and said, hey, we need stimulus. And it's just gone absolutely skyrocketed since then. I know it's crazy to think that you should just buy on a bad tweet, but we're at that point now in our markets. It's driving me nuts.
Well, especially with the president, he's very sensitive to what's going on in the market. So if he says something that drives it down, he wants to drive it back up.
Right.
He's kind of flip-flopping. He almost sounds like a politician now, right?
He's learning.
Yeah. So what I was going to get to is another thing. When it comes to volatility, you got to make sure you choose the right securities. And one thing I've always taught, again, with futures, this works out pretty well, is you take the point value. And every security has a point value. I spelled wrong, value. There it is. So you take that point value, and you want to make sure you have something that you can make money with, you can trade well, but you don't want to have too much volatility. So what I do is I take that point value and multiply it by the daily average true range. So daily ATR it's called. And average true range, if you're not familiar, that's a measure of volatility. It lets you know how much movement there usually is between the high and low of each daily candle. So it kind of gives you an idea of the absolute worst case scenario if you had bought the high or sold the low, but you never do that, right?
No, never.
Yeah, crap it. Anyway, so whatever that value is, that would be the volatility value, I call it.
All right.
Okay, so that volatility value, as a newer trader, you want to keep that not too low because you need to be able to make some money, but a good target is somewhere between, I'll say, 800 to 1200. And by doing that and keeping that value in that range, again, I'm looking at the daily average true range times the point value. For the S&P, the point value is $50, so I'm going to cheat here and bring up a calculator.
That's not cheating.
That's just being smart.
we know you're smart and a CMT, but I don't know if you're a savant. I mean, come on.
I'm only the idiot part. So anyway, so if you take 50 times 65.45, you see that the volatility, if you were to buy at the high and sell the low on average on the S&P, you would lose $3,200. That's a lot of volatility for a new trader. So it was interesting you brought up the fact that, okay, with diversification, we may want something like the S&P over the Dow because the Dow is only 30 stocks while the S&P is over 500. However, again, the S&P has volatility of $3,200. So let me just put that in here. ES.
And for those that are wondering what that 65.545 is, that's the ATR at the bottom of your screen.
Correct. Yeah, you look down at the bottom of the screen. Yeah. That's what I'm using, yeah.
Yep.
So anyway, now if we go to the Dow, and let's do that. We'll go to YMZ 2020. And you can compare any security like this. It's pretty neat when you're looking at all the different futures securities, that is. And you have to do something different for the ETFs. But here we have the Dow. Now the Dow has 508. So let me go back to the ES again. And the Dow has a point value of only $5. So we were looking at 508 points times $5, and you can see the Dow only has volatility of $2,500. Well, only, it's still pretty big. But the Dow is actually less volatile and less dangerous to trade than the S&P based on the volatility and movement of the security. So as a newer trader, you're probably better off trading that versus the S&P, even though the diversification would work better with the S&P.
Yeah.
Yeah, so it's not quite what you think. And we can even compare to the Russell if I go...
Oh, boy.
IZ 2020. That's not as bad. 36.3. So if we take 36.3 times $50 a point, we're only looking at $1,800.
God, so I would have thought that it's more volatile, honestly.
It's a lot less. Well, that was because it's now if you go to the old version, the TF, it was more volatile. But they changed the tick values and the point values to make it a lot easier for people to trade.
Yeah, because it was blowing up accounts like mine. I had a couple bad the TF trades kind of killed me.
Yeah. So what do we have there? Let's see. It was ESZ. I don't know why I keep on saying ESH. Getting ahead of myself here. But yeah, so the Russell, if I go back in comparison, is much more tame. And better for a new trader. RTY equals, what did I say it was? 1815?
18 something, yeah. 1815, yep.
Yeah.
And then let's do it with the Qs. We got Okunola is asking about the Qs. Let's do one more.
Yeah, absolutely. NASDAQ's pretty high volatility. You got 304.30. Okay, so I'm trying to keep them all on the same page here. 304.30.
I was going to try to do the calculations for you, but you're faster than me. Holy cow.
Yeah, 6,000. Yeah, so you want to talk about high volatility. I mean, that's a widowmaker right there, right? So you got the NASDAQ, which is really going to take you apart here. The NQ was greater than $6,000. Whoops.
Gemini says $50 a point. What he's referring to is the tick value or the point value for each of these contracts is going to be different. There's a different value per $1 or per point. So depending on which instrument it is, there's different values there.
I mean, you can go out to something like barchart.com, and right here I can go to futures, contract specifications. These are pretty common for this website. But let's see here, indices. You'll see on the far right the point value. So $50 per point, a 1.0 move in the ES, for instance, translates into either $50 gained or $50 lost.
Right.
But that's how you can compare all these different securities. If you want to compare copper, gold, anything, you're comparing volatility ranges based on their point values. So it's a better gauge as to whether or not you should even be trading a security. I mentioned gold. If we go out GCZ 2020, Gold is $3,300 of volatility because it's 3,370, and again, that's 3,300.
No, it's not. But Gnome says, where can you find the point value in TradeStation? It's not. You can't.
Nah, you go to bar chart.
Yeah.
Barchart.com. It's free for everybody. Under futures, you have contract specifications, and you can find the point values right there. It's the easiest place.
And, just keep that up there for a sec, Brandon. I mean, I think it's really critical that if you are trading futures, that you have to know this. I mean, you have to know that the YM's $5 a point. You have to know that the NASDAQ's 20 and then the S&P's 50. I mean, those are three hugely different values there, which is one of the reasons why when Brandon did his calculations, the Dow wasn't the highest in volatility, even though it's got the highest point value. The value per point is only $5. So when it moves, 1 point, it's only a $5 move, whereas the S&P is going to be 50 and the NASDAQ's going to be 20. So there's very important. And when you start going outside of the indexes, it's critical for all of these things, the grains, meats, metals, softs, that you've got to know the point tick values. Otherwise, you could really get burned.
Yeah, and actually some of the good things to trade would be currencies. You go into currencies, if you're a newer trader, it seems crazy when you look at the point values, right? So if I go to Euro, for instance, you go to the Euro, $125,000 point value. Oh my gosh. Well, honestly, it's going to be about maybe 800 to 1,000 on that ATR measurement. Let me show you. So again, if I go into the Euro, that is going to be 6EZ 2020. And the average true range you can see is 0.0072.
Right.
So again, even though the point value is so high, $125,000, when you multiply that by 0.00721, there it is. That's in that sweet spot that I was talking about. You want to be between $800 and $1,200 for newer traders. You can still make profits, you can still take losses, but it's not going to, it's not going to be as painful and quick for those losses. So that's what we want to do.
Yeah, no, it's great analysis. I love the breakdown of it because it really kind of paints a different picture. And I think this is important because a lot of people may look at the percentage move and go, wow, well, the Russell had a much bigger percentage move over the last 2 weeks. And certainly it did. But if you look at the points per, the value per point, it actually overall would have been a little bit less risk than some of the other asset classes, even though it had a bigger percentage move that has to do with the point value. So interesting stuff.
Well, I mean, that's why whenever you talk to options traders, they never talk about how much money they made. They always talk about percentages that they made because the dollar values are lower, but the percentages are higher.
Right.
The same thing. Yeah, you got to really look at, okay, how much is this going to cost me if I take this trade? Am I really risking too much for my account size and my experience? And as I was saying, you want to find something that's got diversification, which is good. And that's why even the ETFs that follow those futures, you can use those for investment rather than using the futures if you don't want the extra leverage instead of individual stocks. Everybody wants to get rich quick. The problem is, can you handle the risk? Mm-hmm. You got to make sure you can handle that risk before you go into the markets.
For an example on that one, and that's good that you point that out because you get a lot of people, and you'll see it happen all the time from everybody, really. They'll measure their performance with options in a percentage rate and say, well, I made a 25% rate of return on my investment in, 4 days. And the challenge here is you look at something like options, and let's say we're using Amazon as an example. Amazon, $3,400. If you go to buy 100 shares of Amazon at $3,400, you're looking at ponying up $340,000 worth of capital. I mean, that's a lot of money that you have to shell out to make that trade. But you would also be making a bigger percentage on a huge amount of money, whereas with options, you're going to buy one contract, which controls the same 100 shares for what? I don't know, 2,000? 3,000, right? A small little percentage of it, and you can get a higher rate of return, but on a much, much smaller value. So it's math magic that a lot of traders like to use to influence and sway people's opinions about how much they made or didn't make.
Yeah, exactly. I was actually calling up some of the option chain right now just because you mentioned it.
how much is it for? I mean,
let's see, you're looking at the money right now about 3,350. So 3,350 calls are going out to February. Let's see, we'll do 90 days, January's. You're talking about $295.
Yeah,
somewhere around there.
Okay, so you're looking at almost $3,000. So someone might be like, "Oh, I made a 20% rate of return on $3,000," but the other guy's going to go, "Well, I made a 4% rate of return on $340,000." Who at the end of the year is going to be making a lot more money?
Right. But the main thing is we got to manage the risk. We got to understand what we're getting into. You made a good point that if you are trading futures, you got to know what the point values are. If you don't, you're setting yourself up for failure. You got to know what you're getting into when you're getting into those markets, regardless of whether it's options, futures, or Forex. And options are actually another great thing. One of the nice things about the markets right now is if you take a look at, let me see here, get a sharing going again. There we are.
And you got people asking where your bow tie is, buddy.
Oh, I know. I didn't wear the bow. Somebody said we look like we're wearing the same shirt today, but mine's green. I don't know. It's a little different. I don't think it's the same shirt. It's
See,
just a resolution.
The difference, guys, and this is the audience needs to know this. The big difference here is that Brandon's shirt is from Walmart, where you get a 6-pack.
Yeah.
Mine is custom tailored in Vietnam, so just a little bit different there.
Yeah. No, I actually get.
I'm so mean. Sorry,
stuff. Yeah. I get a lot of my stuff from Stitch Fix, I think. Oh no, actually this one was Express. Yeah, this is from the Express. Yeah.
Now bank.
Anyway, what I was gonna say is that you know what, those ones I got from your guys, they fell apart on me. The handmade stuff, those guys that used to come to your house and do the parties and do all that. Yeah, they fell apart. I lost the stitching on a couple of the cuffs.
Huh? You know, it's funny because I still have.
So I wasn't too happy with them.
For those that don't know, I go to. I love going to Southeast Asia. I go to Thailand or Vietnam and get custom tailored clothes. And I get this big package deal. The first time I went was in 2004, and I still have the original shirts from the.
Wow.
Only 3 of them have worn out, but you're just harder on your shirts, Brandon. That's all.
I guess so. Yeah, I get dressed up more. No, I've got some from Thailand, or not Thailand, Singapore. Some handmade trousers and shirts that I still have from Singapore.
Nice.
But anyway, what I was going to show you here was volatility. Yeah, no, I know. I missed the bow tie. I need that.
Mm-hmm. That is your signature, buddy.
I got 'em. Yeah, I know. Maybe next time. But what I was going to show you is this is the VIX, the volatility index. And you can see that overall volatility is a little lower than it was earlier this year. But when you go long term, let me see if I go out to weekly here. You can see the volatility as a whole is higher, more than almost double compared to what it was over the past several years. Mm-hmm. So one of the other nice things that when you're dealing with this higher volatility is looking at doing options now. And when you're dealing with options, I think somebody was mentioning at the beginning when we were waiting for the open of the session here. I think it was it Big Ed? No, can't remember who it was.
I think it was Big Ed was talking options at the very beginning. Yep.
Oh, no, it was Tom.
Tom
was saying, Tom Barr was saying volatility and it's good at option selling. And it is, the higher volatility, the more premium you can receive. You just got to make sure you do the right strategies. You don't want to sell naked, because it's going to be winter and it's a little chilly. But what happens is that when you're doing naked options, you have theoretically unlimited risk. So you can do vertical spreads now, credit spreads, to reduce your risk and take advantage of the higher volatility. So that's another thing you can look into to kind of resistance. Put up a little bit more resistance to the tweets and the volatility in the markets.
Mm-hmm. I had to appease my viewers out there, Brandon. I put a picture of you up with your bow tie on, just so we could get the visual there. As far as risk mitigation of the tweets, I think that there's nothing that you can do to avoid it. I, for one, have been purposely not following. I'm trying not to follow the presidential tweets just because I get annoyed and it frustrates me. But as an active trader, I really do think it's important to be following it because, you notice that he'll say something negative about the markets. It's going to be, trade tariffs on China, the market drops 3%, and then 2 days later, hey, you know what? We're making real good progress on the deal, and the market moves up 9% in 4 days. It's like right now, the tweet thing has been a great builder of many of your accounts. I'm sure many of you are loving it because, especially this last couple of weeks, it's really just been phenomenal. Let's see. Raj says, Brandon, what % of account do you use for taking positions in an ETF? Well, that's a broad question there.
Yeah, I actually don't invest in ETFs. And the reason why is when I'm investing, I want to get some extra leverage. So because I'm comfortable with and understand futures, I actually use futures for investing rather than using the ETFs. I got plenty of things to choose from, which is great. And I actually can use options on futures to hedge a position as well, or even using spreads on futures. And that's something I've been talking about in some of my new classes where, again, you were mentioning about the signature series coming up this month. I'm going to be doing one of those where I'm teaching people how to trade spreads in futures, which gives you the leverage but reduces your risk in the markets. And that's one of the really interesting things about the markets. You can make money 3 different ways using spreads, whereas a directional trader, you only make money if you pick the right direction. So it's almost a 50-50 for the odds.
And Raj, for me as well, I can't say that I do an X amount of position for an ETF. It all depends on the account, and I have a lot of different accounts. Most of the time in an account, I don't want to put everything all in one basket, but I have a specific account right now where I'm just, I have two accounts where all I am doing are selling puts and collecting premium on those, and generally it's going to be on one symbol. So in essence, I'm putting all my equity in one position in that account. So I wouldn't encourage that for most people, but I'm also a very good risk manager, and if I am assigned those shares, I'll manage them appropriately and probably start selling covered calls. But normally in my active trading accounts, I'm not going to put everything all in one position, whereas the longer term accounts, I may, depending on what that account is structured for. So it varies. I think that the challenge here is many of you might have one account. And I think most of the people that I know that are very active and been doing this a long time have a lot of different accounts. I've got multiple futures accounts, I've got Forex accounts, I've got equity accounts, retirement accounts, long-term accounts, short-term accounts. So you kind of need to focus on which one you're going to be dedicating that capital to, and then decide how much you want to put in each position. Richard says, Brandon, this one's for you. He says, do you do research other than reading the charts? And you're a nerd, you're a market geek. I know you do some research out there. What do you look at?
No, really, for the most part, I do primarily looking at the charts. I mean, I'll do different types of charts where I'll do comparisons between related securities rather than just looking at one market by itself. But honestly, I don't do a whole lot of fundamental research because I found it hasn't been necessary. The thing that really comes down to is, as an individual, we don't have as much access to information as the big institutions do. So there's no way that we are ever going to be able to do as much analysis or as in-depth analysis as a major institution. So let them do the analysis and just piggyback on their orders. That's really what I try to do.
Yeah.
Looking at the charts, the institutions can leave footprints where they're buying, where they're selling, and what to buy and what to sell. I was talking about looking at the charts and comparison. One of the things I'll do, let me see, I'll share this again. There we go. And I go into, this is the wrong chart. This is the one. I can take a look at 4 different markets at the same time. I've got the S&P, the NASDAQ, the Russell, and the Dow futures all together right here. And what I can do is compare from a certain point during the day or even during a week. So let me widen this out a little bit more. There we go. And take it to 9:30 this morning. I believe that's where it is. Almost exact. There it is, 9:30 this morning when the bell rang. And we could see that the Russell was leading us to the downside for a while. Initially, it was the NASDAQ leading us down. And when the NASDAQ found a little bit higher low and started to move up, that's where the stronger markets were able to move up as well. So I play what's called follow the leader. And it lets me know which markets I should be investing in. I could change this to different currencies or different energy products, whatever it may be. And it gives me a higher probability of making sure I'm in the right security at the right time and in the right direction. I honestly don't use a lot else.
Yeah, I think that's an important point here, because if Brandon was using a lot of other stuff, what would happen is his opinions might be swayed. And when you look at that chart that he just had up there, all you're really doing is saying, who's the lead dog here? And what are the signs that lead dog is getting tired? And where's the weak dog? And all of a sudden, are they starting to pick up a little bit of steam? To me, that's what's critical in kind of the shorter term style that Brandon and I both do. It's not really, hey, how was earnings? How are the fundamentals? Is the CEO ill? They have a good product coming out? And sadly, that doesn't mean squat. I mean, it's not going to impact a trade for the next day or two. Certainly, if it's an announcement day, you're going to get the big swings from it. But generally, we're just looking to ride that wave of momentum, whether that's a shorter-term trade like I like to look for, or a longer-term one like a Bob Dunn would say, hey, following the bigger trade. It's all about riding that momentum. And if you focus on the fundamentals, a lot of times that can get you out of a position that you may have jumped on because of the momentum. You get out because of the fundamentals, or vice versa. So I personally don't do much research either, other than knowing when announcements come out.
Yeah, I mean, that obviously want to make sure we know we don't get surprised about those major announcements.
And there's been a lot of those lately with regards to earnings, right? We had a earnings season kickoff this week. It's funny. I looked out there today. I don't know how much attention you paid to the earnings calendar, but I'll run through some of them just for the viewers out there today. You had Bank of America and United Airlines both missed earnings. Of course, they were down significantly. United Airlines, you kind of expected that. Bank of America, we talked about that a week ago before this, and I said, look, we've had low interest rates for so long, most likely these banks are going to have disappointing earnings or have struggle meeting their targets. Here's a list of companies that beat earnings expectations today. United Health Group, Goldman Sachs, Wells Fargo, Progressive, PNG Financial, and Alcoa. all of those, except for Goldman Sachs, had pretty substantial down days. You had United Healthcare with a huge down day. Wells Fargo was down massive as well. Goldman Sachs actually looked rather good. But almost everybody beat earnings this week, or today, and suffered for it. So this is where it gets you in trouble, because I've had so many situations where you look at something like Goldman Sachs, and I'll share that. Yeah, I can see the tweet coming in from Big Ed. Yeah, GC was flat. So I'll bring up my screen. I'll bring up Goldman Sachs, and you guys can see let's bring up the 15-minute time frame just so we can see the intraday action on this bad boy, because I want you to see when the announcement came out. It spiked up. It spiked up nicely, and then it's you're right. It's slightly down. I had it as up. So basically, everybody was down today on earnings end, and a majority of them beat earnings, but they were down. So unfortunately, that's just the nature of the beast right now. And if we were to focus on, hey, Wells Fargo, beat earnings, you're thinking it's going to be going up in value. Those types of things would have slaughtered you today. Here's Wells Fargo's chart, WFC. They beat earnings, right? They beat.
Well. Yeah, one thing you got to be careful of when it comes to earnings, most people are worried about the street earnings, and that's not actually what they need to beat. There's
right.
Two things they have to do. Number one, they got to beat the whisper number, which is the real number, and not enough people focus on that, because you can beat what's called the street number, which is what the one that's being reported on CNBC and Bloomberg and all those. But if you don't beat the whisper number, then you still drop. And then the second thing is forward-looking. When they have that telephone call with the CEO, what do they expect going forward?
Right.
Are they expecting good economic times or bad economic times? And that's usually what happens. But yeah, I follow the whisper number versus, I didn't take a look to see what it was today. Which one were you just showing on the stock?
I was showing Wells Fargo.
Wells Fargo? Okay.
Yeah, just so the viewers know, Goldman Sachs was, what were they expect? I want to get the exact number here. Goldman Sachs was expected to come out with $5.58 per share of earnings. And of course, if you don't know the float or anything like that, it's not that important. But $5.58, all right, that's fine. They actually came out at $9.68. They beat by $4 per share. It's a 73% surprise on the estimates out there. Of course, Brandon's right. There is a whisper number that is probably more significant. But boy, you have blowout earnings like that and you tank, that's rough. They didn't tank. So they were flat on the day, but still. Yeah, pretty big beat.
Yeah. No, I was just taking a look to see if I could find, there's Goldman Sachs trending reports.
And actually, Joseph says GS made money from bond trading. Yes, a lot of them are saying that the bond market has been where they've been making a lot of money on it. And, great. You see, a couple years ago, it was all off their trading departments. Now that's sort of switched over to the bond department. So there you go.
Yeah.
All right.
I was trying to find that Earnings Whispers. There we go, earningswhispers.com. There's a couple of websites you can go out to for those whisper numbers. Like I said, if you go out to, I'll share my screen once again. These are all free websites, but this one's Earnings Whispers. There's also whispernumbers.com, I believe. But if you go out there and look, a lot of times they'll show you right here. There's the consensus number. This happens to be PII. Don't know anything about it. Don't really care. But I'll zoom in here real quick so you can see it better. There you go. And you can see that the Earnings Whisper is 239, but the consensus is 218. So if they came out with a number, say 220, you'd be saying, wow, wait a minute, they beat the consensus. That's the one that they're reporting on television because they beat it by 2 cents. But if they don't get anywhere near that whisper number, it's going to get crushed. So that's the real number you got to pay attention to, not what they're talking about on television. And these are free websites. This one's earningwhispers.com, and there's also a Whisper Numbers or whispernumber.com, something like that. I got to look it up. But I'd have to look. You see Alibaba misses by a penny. They give you some information on that. And if it gives me, I'm not sure if it'll give me the actual results versus what the whisper was. Yeah, reported earnings, 209. The consensus estimate for Alibaba, here's a great example. You got 209 for the earnings report. You got the whisper at 211. They missed by 2 pennies, even though they beat the consensus of 193. So what happened to the stock? Okay, well, let's take a look. I don't know.
I got it up over here.
Oh, you do? Okay.
Yeah. And that was today?
I believe so. Let me just check.
I didn't even see it on my list, but here's Alibaba, guys. You can see just a pretty ugly day for it, down 3.26%. And even if it beat.
Because it missed the whisper.
Yeah.
That's one of the main things. They beat the consensus by a lot. It was 193. They beat it, but it was 209. But however, it was 211 for the whisper. They missed the whisper number, and they get punished because they missed the whisper.
The beauty of the financial markets. They don't no respect for anybody out there. there was a comment from Joseph here, which I like. It says, good traders are making money during this pandemic. And I'll be blunt here, and of course I'm sure the FTC is going to love this one. I think that a good trader is going to make money in any market. It's just about... They should be. And the challenge is changing. And I'm sure some of you may have felt that pinch because there's periods where the market goes on a long bull run, and you don't need to have brains. You just need to buy stuff and just hold it during that rally. Unfortunately, markets change, and we'll go into a period of time where it just goes sideways and is real choppy, and someone who's astute realizes it's no longer just buy the dips anymore. It's buy the dips and also sell those highs and try to find that zone. And then you get the period where it's all of a sudden a downtrend, and those people who are one-directional and are always buy and hold investors, they'll lose everything they have. Or be in positions that are so underwater that they take years to come back. I know a lot of traders that did that back in 2000 and took them almost 10, 12 years to finally get back to profitability on some of these positions. That's wasted time. So I think that a good trader knows immediately when to go, okay, you know what? I was using my long sniper rifle. Well, now I'm up close. I need to go handgun, or I'm even closer. I need to use a knife. I mean, these types of things are critical. Sorry, I know you're the veteran, not me. But I think you'd agree. You need to know what weapon to use and what fight, and we have to change. We have to be very quick to change as these markets do.
Yeah. Was this the market could say wrong more than you could say, or longer than you could say solvent?
Yeah.
Yeah. Let go of the ego.
Yeah, absolutely. Let's see. I got one ticker symbol that was sent in. Oh, you know what? Hold on. I actually had a couple questions that came in. Let me see if we can go through these questions real quick, just to appease. Okay, here's the first question. Michelle says, are there any advantages or disadvantages to trading a futures contract that is not the current contract? For example, the X20 or the Z20?
Well, there's definitely going to be a couple disadvantages. One of the main disadvantages would be the spread. So if you were to go out and, we actually have to deal with this quite often. I'm going to share my desktop again, but go out to my trading platform here for Trade Futures Trader. Here we go. And here's a good example. We've got gasoline, RBX20, and you can see the spread or the difference between bid ask. Now, it's going to be different right now because of the time of day. But when I go to RB, let's say, well, even the U21, but let's go F21. That's January. Notice the price difference. Mm-hmm. Here, it's 118 to 120, and that's on the November contract. On this January 2021, it's 115, 120. So you've got this huge spread that you have to overcome. And the further you go out, the worse it gets. So even if you just go out one or two contracts, RBZ20, you can still see the big difference between this RBZ20, 115.50, 118. That's $3 difference compared to a $2 difference on the front month contract or the near contract. So that's going to be one of the big disadvantages. The other thing is going to be the price movement. The further out contracts will not move nearly as quickly because there's lack of volume, and they can even gap intraday. So remember, charts are created by transactions that occur. However, the prices can change without a trade occurring. You can change your bids and offers without the actual charts reflecting that until another trade comes in. Mm-hmm. So that's where you can sometimes get intraday gaps. So you want to be careful. So even though people are sometimes investing in futures, it's better to invest in the near month and do what's called rollover when necessary. That would be exiting the near contract and rolling to the next contract at expiration. It's usually better, and you get better pricing than if you just try to go and buy a longer term contract because you want to avoid the rollover.
Yeah, so the big challenge in trading those different things is liquidity. Most of the action, most of the volume is going to be on that current contract. So that's what you want to be trading. And it sounds kind of stupid, like, well, you want to be trading when everybody else is. But remember, we've had this discussion before. When you have more competition, you get better price efficiency, better price discovery. And those spreads, as you go further out into into a futures contract that might be, 6, 8, 12 months out, well, all of a sudden, there's not a lot of people trading that, so the spreads could be very big, and also the liquidity factor could prevent you from getting a price that you want when you're trying to get out. So that's probably the biggest disadvantage, is that price discovery mechanism, the illiquidity of those markets. As far as advantages, well, you just have a little bit more time. I mean, you don't have to worry about rolling it every month and every month and every month. But, I agree with Brandon. I'd say with the most current one, I think that's your best bet.
No, I mean, you can even see it right here in crude oil. Now, there are going to be some advantages sometimes. Notice in crude oil right now, the November contract is showing volume of 302,000 contracts. And you can see the price movement today was 91 cents to the upside. You go down a little bit here, and there's going to be some pockets of liquidity, but you got to make sure that you have enough liquidity, and you said it, to get out of your position. Getting in is not a problem usually. It's getting out at favorable prices. So here we have a little pocket of of liquidity on the June contract of 33,000 contracts. Everything else is, less than 20 grand. As far as the volume, 10,000 here for April, and also the price movement is a lot smaller. Notice the front month contract, 91 cents, going to this June contract, only 60 cents. Now, I do trade those back contracts, but I do it as part of a spread, taking advantage of those mispricing between those different contracts.
Nice. I know since it was option rollover every third Friday of every month. Yes.
For options, not futures though.
Not futures, and honestly, for futures, it depends on the contract. Depends whether it's a weekly, a monthly, a quarterly. I mean, there's different expirations for each of those. It can be a little more challenging, but we can cover that more in depth. Actually, speaking of which, I know that you're doing a signature series where you talk a lot about spread trading. You want to tell us about that?
Actually, for Online Trading Academy, towards the end of the month. Let's see, the dates are October 23rd, 24th, 25th. I'm doing it over a weekend. I'm going to be doing something called my Signature Series course. It's a 3-day course teaching you how to trade spreads and how to find the trades, manage the trades, all sorts of fun stuff. It's just dedicated to that. It's got a few little tricks on my sleeve in order to be able to chart the spreads. But the nice thing about spread trading versus trading the normal directional, as I was mentioning before, you actually have higher probability of success because you're making money based on price relationships between two securities going back to the norm. Most securities have what is called, they're mean reverting. So if they go out of whack, they go do something unusual, they usually revert back to their average pricing. And the same thing happens with the relationship. So we're just exploiting that opportunity. And it's funny because most people have no idea what spread trading is all about. They think about options when they think spreads. When it comes to the professional trading that's out there, if you take a look at something like wheat or corn, roughly 25% of all the contracts that are being traded are done through spread trading. So this is not something that's very small. It's actually quite accepted and normal for many of the institutions. It's just not something that most individuals like ourselves tend to get into because they just don't understand it. But it's a way of reducing your margin costs, number one. For instance, you could trade overnight on the NASDAQ. If you hold a contract of the NASDAQ overnight, it's $17,000 for margin typically. However, if you do it as a spread, you reduce the margin costs all the way down to $407. Isn't that incredible? You go from 17 grand to $400. So you can reduce your costs and still make a longer term investment in some of those futures overnight. You also reduce your risk. Now, with reducing risk, you're going to reduce your reward, but the percentage, the rate of return actually goes up, believe it or not. So that's going to be October 23rd through 25th. If you happen to be an Online Trading Academy student, I'm doing a workshop on this Friday actually, at 1 o'clock in the afternoon Eastern, so that's 10 a.m. Pacific, I believe it is. Yep. So just check your calendar. It's called the Signature Showcase, so you can learn more about that there.
Nice. I'll be in there one way or another. I'll be in that session on Friday.
All right.
Awesome. Well, all right, Brandon. Well, thank you so much. I appreciate you giving us little insights into the Twitter thing. It's not like a groundbreaking, revolutionary thing, but I think people have to be thinking about it. If you're trying to protect your long-term portfolio against this type of stuff, best thing to do is find something that's well diversified. You could also be using options during that period of time, so not only buying the underlying, but have options there as well, and further reduce that volatility by using the option strategy. So again, thanks so much for joining us today. I look forward to your Signature Series. Yep. Should be a fun one.
Thank you. Yeah, it should be. And thanks for having me here again.
Always a pleasure. You soon. I'll see you in a month, buddy. Take care.
Yeah. You too.
All right, guys. That was Brandon Wendell. If you want to be a part of his Signature Series with the Online Trading Academy, if you're a graduate, it'll be the 23rd, 4th, and 5th of October. That should be good. Unfortunately, I will be gone those days, but I will probably be on there on this Friday with Brandon talking about his Signature Series a little bit. So if you guys want more information, contact your local Online Trading Academy center. There you go. And yeah, I was posting Brandon's name on the screen there, which was at TraderBDub. So if you guys want, you can always check him out. He's always posting about various markets out there. I would encourage you to check those out. A lot of times it might be a market that you may not be interested in. I know some of you are probably not going to be trading the Nifty 50. Well, Brandon will do analysis on that one as well. Also, I had to give a big shout out to Ed. Thank you so much for the contribution earlier. Sorry I missed that. Ed in San Jose sent in some donations, so I appreciate that, Ed. Thank you very much, and also your comments and support on the show over the past couple weeks or a couple months. I do appreciate that as well. Let me go into economic calendar. I want to get some to listener questions, but I don't have enough time here to get through everything. I was going to show you what happened out there today. So let me bring this up full screen. Here's what we had happen today, and I just wanted to show you these because I read through some of these numbers, but boy, you look at that. These are this column here under percent surprise. These is pretty impressive. Like there's a lot of big beats out there, and just about every single one of these companies ended down on the day. Crazy. Yeah, and some pretty significant downside moves as well. Goldman Sachs was almost break even. Pretty crazy how that happened. Anyway, bank stocks really took the brunt of it today. Tomorrow, you're going to have... actually, let me go to economic calendar first. I guess I put these out of order. Here's your economic calendar for tomorrow. You have unemployment claims, which are expected to decline again. Of note for me tomorrow is this Empire State Manufacturing Index. Remember, we saw that down below the zero pretty significantly, and it came ripping back up to now positive territory, but slowly drifting back down, and that's the expectation. It's going to go from 17 to 13.9. Remember, anything above zero represents economic expansion in the manufacturing index area. We also have crude oil inventories tomorrow, natural gas storage. So if you're trading the CL or NGs, be careful. You might get some big volatility because of that. And then here is your earnings calendar for tomorrow. These are also pretty big movers. You have ISRG, which tends to be very volatile anyway. Walgreens Boots Alliance, which is a Dow component. You also have Morgan Stanley and Honeywell reporting earnings tomorrow, and that is the majority of your economic and earnings announcements. Now, there are more than this, guys. I think there's something like... I think there's 40-something earning announcements tomorrow, and I only picked 4, but I just went with the big names, the ones you probably recognize the most out of it all. All right, that's going to do it for me, guys. I got to go and get ready for another webinar. For those of you who are Online Trading Academy graduates, you probably saw that I believe Mark Greco and Todd Davis are going to be doing a webinar on Click, which should be a fun one. I think that's going to happen right after this, so I need to jump out and jump onto that one. I think it's happening today. Unless I'm mistaken, it's tomorrow, but I do think it's today, so I'm going to go check that one out. That will do it for me. For tomorrow, we're going to have Tilly Allison on the program, and we're going to be going over just chart analysis, a variety of different instruments. If there are things that you would like us to check out, I would encourage you to do so. Send them on in at TraderMerlin.com. You can send me pretty much anything there, or put it down in the comments down below the video, and I will get to as many of those as I can. I see I didn't get a lot of questions answered today, so I apologize for that. Best thing you can do would be to put it down in the chat below the YouTube video so I can make a list and get it all ready for the show before the show. Sometimes live things just take some time and I don't get to them all. But anyway, on that note, hope you guys enjoyed Brandon Wendell. He's always great on the program. Learned a little bit of something. Happy trading, everybody. I will see you tomorrow.